In 3, 2, 1, go time. All right, fellow podcasters, welcome. Today on G Money, Real Talk with everything mortgages and real estate. I have a good friend and colleague, which is Ben Suddock of Suddock Insurance Agency. Welcome, Ben.
Thank you very much, Craig.
Yeah, so I invited Ben in. I've known Ben for quite a while. I do some insurance with him. I do a lot of referrals with him. I felt it would be just a really good conversation to have for our listeners. A parallel industry with what we do in mortgages. We cannot close a mortgage without insurance. And it's something that it protects the lender, but it also protects you, the individual. And so, it's something to really understand if you have to have it, which you want to have it, know what you're getting into, right?
Absolutely. And, oftentimes the home is the largest asset someone might purchase, and certainly we want to protect that asset.
Absolutely. So again, Ben, thanks for sharing and joining us today.
My pleasure.
Why don't you just kind of give me a few little tidbits about yourself, how long you've been doing this, and some of the products that you sell, et cetera.
Well, I've been in the insurance business for quite a number of years and started out as a farmer's agent and then moved my way into the independent agent world where I'm now a broker. And we deal with multiple companies. So we're not just honed in or focused in on one particular company. So we can really try to design a package of insurance that suits the needs and not only the price, but the coverage, which is, to me, it's more important than the price is the coverage, making sure that it fits the need of our customer. And that's the point I'd like to make for the customers out there, buyers of insurance, is you really need to sit down with your insurance agent and discuss your needs, the particulars. One policy is not necessarily the same as the other, even though they all say homeowner policy on them. There can be a lot of differences between it, and those differences need to be understood by the buyer.
Yes.
And my question, I guess, to many of my customers is, if something happened to your home, what would you expect from your insurance company?
Yeah.
Would you want them to rebuild the house? Well, that's normally the obvious thing. Want them to be able to rebuild it? Well, we have to make sure you have enough coverage and that the coverage is appropriate to do just that. So right. For the customer needs to understand what their insurance is, and that's best done by speaking with their agent and not some 800 number in Texas or New York or someplace.
Ben, I really couldn't agree more. It's very similar to like what we do in mortgages. We're local, we're live, we're in person. We're here trying to meet with our clients, not just offer them an excellent rate and service, but really be the advisor for them of what their needs are and how to properly address that. And we're constantly shopped from these online, marts, who knows where they're calling from, and it really doesn't matter, but there is a difference in service of, like you said, if something happens, insurance-wise, and it's 7 o'clock at night and there's a fire, who do you call and where do you go? I mean, it's more than, are they going to rebuild my home or repair it? It's like, what do I do now?
Exactly.
Right? Yeah. So... you make some really good points there.
And an agent is the one that can help you through that process and make you or help you to understand.
I have an embarrassing admission to make here, and I will say I've learned from my lesson, and I learned early enough in life that I learned from my lesson is, when you're young, you get your driver's license. I was very independent. I purchased my own vehicle, got my own insurance, and you can imagine that early insurance coverage. And I may have gotten into an accident on the freeway, and it was my fault. And not only did one car get involved, but a second car get involved, and a third car that got involved. And to say it escalated quickly, it escalated quickly. And, this was, I'm not going to date myself. I'm not going to say the year, but let's just say, Lexuses were new and very nice and very expensive at the time, and they still are. But when I saw that there was a Lexus involved, I was like, yes, this pretty much exceeds my coverage. And so that was an eye-opener for myself of like, looking at the coverages, hey, $100,000 sounds good, but in modern cars, $100,000 doesn't get us very far. So think about your house. How far does $100,000 get us anymore?
Right. And that's a part of working with your agent, is to help determine the amount of coverage that you should have on your house. And we tend to call that the replacement cost, or what it's going to cost to replace your home with today's dollars. It has nothing to do with the real estate price or how much the loan is. That has nothing to do with what's it going to cost to rebuild the house. And as we all know, with inflation doing what it is now, the cost of materials is going up, not as well as labor.
Yeah, so this is kind of a great segue, because I just pulled up, a current policy that I have, and it was like, initially when we had a conversation, what was it that we did talk about? And so what you're talking about would be the dwelling coverage.
Yes.
And then with that, how does that parallel with the mortgage side is when we offer a loan and we do a loan for $1 million, we'd like to see $1 million of coverage. However, that's not always the case.
True.
And so we rely upon the insurance company to run what's called the replacement cost estimate. I don't know if you call it the same thing, but that's what we ask for. Okay, you live by the beach, yet it's only an 800 square foot home. So you're acquiring it for $1 million, and that's the value of today's sales comparison.
Real estate value.
Real estate value. But on an insured value, that home of 800 square feet, you have a replacement value of $200,000 or $300,000. I mean, you tell me.
Well, this is a moving target here on that, and we have to rely on certain programs we have to do that. But like you say, we are going to look for what it's going to cost us to replace that home, and the value, that $1 million value, is not relevant to us at all. An 800,000 square or 1,000 square foot house might run $300 a square foot. So do the math: $300,000 on the house. But then again, that house may have something really spectacular: cherry floors and cherry cabinets, and really things that drive it up above $300. So there's that to look into, is what's different from this house. I mean, we initially might talk on just average. The average house is $250, $300, whatever, a square foot. But this house over here, well, man, I mean, those are Anderson windows and all this stuff, and quartz countertops and all that.
Thank you, and I think that's good information to put out there. Looking again at this coverage, there's other things like other structures. Is that a garage? Is that a barn? Like what would be covered under other structures?
Well, these are things that are not attached to the house. You might have a shed, for instance, or a detached garage.
Okay.
It could be fence. These are things that are on the property that are not attached to the dwelling.
Mm-hmm. Okay. Personal property. So that's clearly personal property. Now, I know that this also gets more detailed, so this would be like, my televisions, my couches, things like that.
Well, think of it as things that are inside the home itself that aren't attached.
Yeah.
Okay? Like the things you mentioned, your TV and your dishes and your clothing and all of those.
And then this can go where there's also a replacement cost, right? There's a depreciated value unless you have replacement cost, or...
Yes, replacement cost is an option.
Okay.
And we're talking contents now, or your personal property. We mostly call it contents.
Sure.
And it's replacement cost or actual cash value, and that it's an option that you buy. So if you have a couch that's 5 years old and it gets destroyed by a covered peril,
okay, thank you.
Some of the policies covered.
Yeah.
Then do you want that replaced with something of like kind and quality, or do you want to take an actual cash value and get some depreciated value on that? So most people will go for the replacement cost, and so we're going to replace those items in the house. Say there was a fire and the smoke damage and water damage and all that stuff that happens. All of those items are going to be looked at on a replacement cost basis.
Okay. Yeah, makes sense. I want that, and I definitely have that. I mean,
good for you.
Yeah,
you must have a good agent.
Yes, I do. Okay, personal liability. So this is showing $500,000. So I have a party at my house. This is where personal liability comes into place.
Yes, it's for injuries that occur on your property, and also some liability can occur off your property. So the personal liability extends from not only your primary residence or the property that we're insuring, but can extend off premises for liability, not automobile or boat or motorcycle, that kind of stuff. But I use an example oftentimes of you're on the golf course and you nail somebody in the head with a golf ball. Well, there could be some liability incurred there, and your homeowner policy is the one that's going to respond on that.
Are we supposed to stick around at the golf course when
No, you
that
leave
happens?
right away.
Okay. I wasn't sure. So in case they get your yeah. Okay. Now they also have for enhancements here extended replacement costs, which is reflecting 150%. And I know that goes back to dwelling. So maybe you can explain a little bit what that means.
Well, let's just keep it, small numbers for my little brain here.
Yeah, yeah.
Let's say we insure a house for $100,000, and then we have the optional coverage of extended replacement costs. And you mentioned 50%. There are companies out there that will write it for 20% or 25%. 50% is kind of a high number that is really a nice number.
Yeah.
But it just means that if your house at the time of loss is going to cost more than that $100,000, we've got another 50% of that limit, in this case $50,000, that we can apply to replacing or rebuilding that house.
Yeah. No, and that's good, really good coverage, I feel, and also good to know about.
Well, you really do want that because determining what the replacement cost is a really big guessing game. There's no way anyone's going to know at the time of loss how much that costs or the house is going to cost to replace. So this is called a buffer, a little extra, amount in there that just hedges the bet.
Yep. Loss of use. I mean, that seems pretty self-explanatory, but like in the case of a fire, they have to put me up in a hotel and maybe long-term in a Airbnb. That's loss of use.
Yes, it's your what we also call it additional living expense. So it's those expenses over and above what your normal everyday thing would have been at your residence that got destroyed.
Yeah.
And so there'd be a hotel room and food and clothing and things that got torn up. That could be in that additional living expense. So, and that's just a wonderful benefit of the policy.
Yeah, there's a bunch of miscellaneous stuff. Loss assessment.
In most, we're talking regular homeowner policy on a say tract house or something like that.
Yeah.
That coverage isn't really going to apply. That's going to be more like in a condo situation where the condominium association might special assess those members or the owners of the units for something. And again, there's conditions where this applies, and it has to be a covered peril and all of that. But it's going to be something that driven by the association.
Okay. Backup of sewers and drains, clearly plumbing stuff.
Right.
Equipment breakdown, so that I would imagine HVAC and some of the main components.
Right. Your electrical could be your electrical system, or where it shorts out from within, and air conditioners, that sort of thing. Identity
recovery, and I have seen this in multiple policies. The identity recovery.
So, these are little spiffs or little extra little add-on, call it fluff, coverage that a lot of companies will throw in there.
Now, correct me if I'm wrong, it's nice to have all these little fluff things, but you start using your insurance and it can come back to you to haunt you, right? In time of renewal and premiums and things like that.
Well, there are times when that can happen, and one. Probably the one I would single out would be frequency. If you have a bike stolen every other month, and the insurance company is kind of going to go, hey, now wait a minute, we got to make a change here. This isn't normal, and that sort of thing. So frequency is an issue like that. Using your insurance, that's what it's there for. Now, let's say all these policies have a deductible, and the higher the deductible, the lower the premium. And a lot of times people will put a $5,000 deductible on a policy just to get the premium down.
Sure.
And there's some that can't manage that $5,000. They want to have a $500 deductible, and they may pay, and they will pay a little bit more for that. If you go several years with your policy and you don't have losses, then you typically will start getting some loss-free or I should say, well, just loss-free discounts. Those will go away if you start reporting claims.
Sure.
And so, yes, it can impact, but that shouldn't really be the basis of whether you turn a claim in. If you've got a $500 deductible and you got a $700 bike that gets stolen, I really wouldn't turn a claim in for that, because you are going to pay the price and higher premiums. And like, again, frequency can also lead to being non-renewed. If an insurance company feels that you're just outside that norm of loss and things, they can non-renew you and say, see ya.
Right. Now, I've had, and I want to kind of get your take and clarification as well. Again, I work with insurance companies. I have for the last 22 years on the mortgage side of this. And I had a client purchasing a home. They didn't even own it yet. They're just getting quotes. And they had a heck of a time getting insurance because there was multiple water claims on the property. And so we had to go to the seller and really document. And, I think it was kind of their naive on their part of, hey, we can use it. And because it really wasn't that large of claims, but there was 3 claims within a short amount of time period. And so for our borrower to come along, he hasn't been insured. There must be a database that is shared by all insurers. Is that correct? Or how do they learn about the losses?
There's something called a clue report.
Okay.
And you call it like a credit report almost,
sure,
like you would use for mortgages.
Yeah.
But there's claim history is reported, and it can be accessed by most insurance companies. And you're very right in what you illustrated there. If there's a particular property has had multiple claims, companies find out as they're underwriting it, then they're not going to be too anxious to write that unless they can document or have documented, show that something's changed to make that not happen again, such as the house being replumbed.
Yeah.
Okay. If we have permits and we have evidence that the house has been replumbed, then that's not probably going to be an issue.
Right, right. So I guess the moral here to share is you should have ample coverage. You should have good coverage, but I think if somebody goes with a $500 deductible, yes, it's convenient when you need a claim, but almost too convenient at $500, right? You don't want to turn in a claim for $750 and get reimbursed $250. It's kind of pointless to get your insurance involved, and it could later hinder you, not just in renewal time and premium time, but also the resale value of your home by having multiple or excess claims, correct?
It could.
Yeah. Yeah. So again, this is that information that I really want to share with everybody to kind of understand a lot better of what they're getting into.
Just on that, you should keep in mind that insurance is replacing you as the person going to lose. So you're transferring the risk is what we call it.
Yeah.
And so you're sharing in that transfer of risk by the deductible. And to whatever extent you can feel comfortable as sharing in that expense, you should do it. Whether it be $1,000 or $2,500, $5,000 deductible. I have some customers that have a $25,000 deductible. They are able to manage that.
Sure.
But you really don't want to be thinking I'm going to just turn this into insurance and thinking nothing's bad going to happen, because like you say, I don't mean bad that they're not going to pay the claim.
Sure.
I just mean they're going to either get tired of paying those small claims and non-renew a person, or jack the rate up, and that's not good either.
Right. So I've got just kind of a few questions here that, again, they stem from working with many insurance companies. When we are doing a purchase or refinance, we have to reach out to the insurance company and update the evidence of insurance. We have our mortgagee clause, so we need to have American Pacific Mortgage listed on there with our, its successors and or assigns, and our loan number. You're familiar with all that. And,
oh yeah.
And a couple notes here. Or one, and this is not batting on you and your age at all, but it seems like the preferred method is by fax. Is this an industry standard, or is this just kind of the luck of the odds that I have, where these insurance, I feel like it's only insurance companies and it's only medical field where they want to do everything by fax versus email?
Well, I say we're email.
I know, and that's where you shine. And so you're kind of looking at me dumbfounded because, and probably some of the reasons of, when I started doing business with you early on is how easy it was to do business. We send an email, get a quote right back, send over a request for evidence. We have all of the information listed. We get a lot of resistance, and I'm sure like you deal with enough lenders out there that make these requests and make you spin in circles, but it just feels very archaic in some of the requests that we make and the responses or lack thereof. We even get it where some insurance companies won't even work with us. They only want a request from the escrow company. And to me, that's later down the line that we need the insurance prior to the loan documents even getting to escrow. So again, just kind of wanted your comments of like, not necessarily how you do this, but in the industry, are you aware of this? Do you hear these kinds of things?
I've heard from various escrow companies and even lenders that will come back and say that they want it a certain way or something like that. We just try to accommodate that. Again, we do so much by email, and I do get comments from some of these same folks that say, gee, that made it easy for us. And
right.
Really, that's our goal, is to make it easy. This should not be complicated and difficult, for any of the parties to get this deal put together.
Right. I've heard different terminology, a word called binder. I know insurance, like we need an evidence of insurance where it's actually in place. Is there a difference between a binder and an evidence of insurance?
Yes. When we write a new policy, and it takes maybe, of course, nowadays it's getting faster and faster when insurance companies actually issue policies.
Sure.
But in the days of old, we would submit an application for issue, and then we would issue a binder until that policy got issued. Typically, that would be 30 days. And so that would be a temporary policy, that binder, until the actual policy came in. Well, today, things move much more quickly,
sure.
And we all like that, of course.
Yeah.
But we can usually get a policy issued the same day or the day after, whatever. And we'll generate a certificate of insurance. And all that is really a picture of what your insurance is that you've put together and that we've committed to write.
Sure.
So most lenders will accept a evidence of insurance, and we call it evidence of property insurance, and we'll put the liability coverage and all that on there. But the lender is typically really just interested in the the dwelling coverage and the deductible and that sort of thing, and we provide that on this certificate to them, and they're happy little campers, and we go on down the road.
Yeah. With the evidence, we would need premium. We always need to know the cost. And then we also need to know the effective dates. So typically in the evidence of insurance, it has all of that. And that's where I'm just going from memory of our doc drawers, and they seem like they're picky, but there's a reason to that.
Well, the lenders, in many cases, they want to know what the insurance company is and what their rating is, and there's a way that's done. There's a program for rating insurance companies. And the premium and the amounts of the coverage on the dwelling and the deductible and all that, the policy number, if we've got that, or we'll sometimes put a binder number in there if we had to. But most of the time these days we have a policy number that we put there. But they want all this to put into their file as proof of insurance, because they're not going to, as you know, they're not going to let loose of a penny until they know that that's secured by insurance.
And a lot of that, the premium goes into the loan documents. So if we have bad data or the incorrect premium, it could affect the loan that we write. Sure. Also, not all, but most of the loans have impounds, the optional for the escrow and of the property taxes and insurance. And we need to know when it renews so that the escrow account is properly set up. Right. With funds, so it is a dollars and cents reason of why we would need to have that information.
Certainly.
Yeah. So
and it makes it really nice for the borrower, the homeowner, to have that. I mean, I like impound accounts for that reason, that the taxes and the insurance gets put into the monthly payment and then paid out by them. They don't have to think about it or worry about it, and or be late on it or whatever.
Yeah. So you were just kind of saying, and we're talking about issuing the evidence of insurance. When somebody gets a new quote, and that's what I always recommend: get a quote, get a couple quotes, get the coverages that you want, get the quote narrowed down to how you want it, and then provide me the insurance agent contact information. What goes into a quote? Because it's not you qualify the borrower as well, right? Is there qualifying things of their age and dependence and that kind of stuff? Like, how much goes into the rating of it, I guess?
Well, in California, we cannot do a credit report for homeowner insurance purposes, so that element is not there.
Okay.
So we're looking at the house itself, the dwelling, as its location. Is it on the beach, getting slapped by the water, or is it up on a hill, with a lot of brush around it? All of those are factors we use. Age. We'll do this clue report that helps us to determine prior losses and whether that's going to be make it ineligible, perhaps.
So that is on the borrower side, not property, right? The clue, like if
the clue
Johnny borrower here has 3 previous claims, then you can take that into account on the new insurance, correct?
Could. If Johnny, if those claims are the water losses you described, that's on the house.
Okay.
Johnny didn't do that. That was the age of the plumbing, perhaps.
Sure.
So that clue report is really going to be on the property mostly.
Okay.
We do have the clue report will show just claims in general. So it could. If we're seeing a lot of claims like that bicycle being stolen, we know Johnny's got a problem. He's not locking his garage door or something like that. So that can enter into it too. But mostly when we're looking at new property, house dwellings to write, we're going to be looking at the property and looking at where it's at. Does it have a shake roof? The condition of the house, all that. So we're going to gather the facts as we can and develop a program based around that.
Yeah. Makes sense. Kind of switching into, and I'm not trying to grill you on any sense, but I want to kind of, again, things that impact us on the mortgage side. How much do we qualify a client for? We have to have the numbers of property taxes, homeowners insurance. And so, I always try to do my best of, does it lie next to brush? Is it a rural area? Some of these things. And then I lend, all over Northern California. I'm now licensed in Oregon and Washington. So, we have had a history of bad fires, and unfortunately, we've lived through that. I never thought I'd say that here with the Thomas Fire, one of the state's worst fires. And, maybe I just like to kind of get your feedback. We've never had this conversation. I'm sure you've had clients impacted. I mean, half of Ventura was hillside and went up in flames. At the mall, they had insurance vans and semis and, really staging areas for insurance claims. It was quite something. That's all I can say. And it wasn't that long ago that we had that. So maybe just, if you don't mind sharing a little bit about the Thomas Fire and how that impacted you and your clients.
Well, we had 3 totals, which isn't bad considering how many there were in total. So, and quite a number of partial with smoke damage and just moderate fire damage. But we had 3 totals, and it's pretty devastating on those families. But the aftermath of it is that a lot of carriers withdrew from riding up on the hill and anywhere near the hill because of that brush. And it made the market really tight at that point, and we fell into doing some fair plan quotes and with some markets that we might not normally deal with just because of the availability. Just your primary carriers, AAA and State Farm and a lot of Safeco and a lot of the others. They just stopped writing with any proximity to the brush at all.
Now, And 3, it doesn't sound like a significant number, but it is when you take it into account. What if that were your home? What if that was everything that you owned? I mean, and I'm sure you dealt directly with them, and you were there as the liaison with the claims department and helping them through that process. Does that change how you write future policies and how you kind of make suggestions? I don't know. I mean, I just my own personal thing here, and I'm not trying to put words in your mouth. I guess living through something like that, you would almost want to make sure everybody is really protected versus just trying to be the cheapest guy on the block and say, hey, really think about this.
Well, there's a little phrase we have is insuring to value, and that's been even before the Thomas Fire. That was primary goal of ours is to be sure people have adequate insurance to take care of the situation as best as we possibly can. And we didn't have anybody that was underinsured. That's the other phrase.
Yeah.
Not having adequate insurance. We had adequate insurance on it all. And I guess it was just a reminder that that's the job we have to and need to continue to do is make sure. We get questions from people all the time. Well, my house is only worth this or that, or my loan is only this amount or whatever. And again, going back, it's not relevant. It's how much is it going to cost us to rebuild that house? I mean, that's if we agree that if your house burns down, what would you want your insurance company to do?
Yeah.
The first question that we talked about. We want to rebuild the house. Well, then we have to get adequate amount of insurance, and we have to be realistic about it. I've had contractors that I've dealt with, and they say, "Well, I can build this house for $30." Well, good for you, but it's not the way it's going to work.
Right. And I think thank you, and that's good. For me to hear. Obviously, you've been protecting your clients, and I don't think it's ever a perfect math formula, but putting it into perspective. I have a little mountain house up by Yosemite, and the insurance is dang near doubled every year. And of course, it's frustrating. But at the same time, right now, I think it's, I just got renewal $3,300 or something like that. And I'm like, could I rebuild my house for $3,300? Even in a lifetime of owning that, I don't know if it were a total loss that I would ever break even with that. I think that helps me put it into perspective of, there's a lot of claims out there, and especially it goes, I think, in waves. And I've just seen it nationwide. You look on the news and, there's a hurricane or a tornado, and they've got 1,000 or 1,500 cars parked in a field that are all total losses that they have to pay out on. And they come to the Thomas Fire, and they've got 3 houses, just one insurance company. It adds up.
It does.
What I have a frustration with is also familiar with the mountain communities is the California Fair Plan. And that's where, and I want your take. I mean, obviously you're kind of with this, but for those that don't know, a property could be uninsurable from all private companies. So State Farm, Farmers, whoever, whatever company you want to say, they all collaboratively just say, hey, we're not going to insure this. And so the state of California will then step in and insure it, but it's just structural. I mean, yeah.
Okay, well, we're writing a lot with California Fair Plan these days, and because I do write in some of the mountain communities, and it isn't always just fire out there. We have had a lot of snow claims this year, with this heavy inundation of snow and the weight of the snow and
lose a roof
rain.
Real quick.
Yes, I've got a couple of those. So the Fair Plan has really come into play, but the Fair Plan touts itself as the last choice.
Sure.
They don't really want to write business unless they have to, but they are put in place for that purpose, for those cases where you cannot find insurance elsewhere. The Fair Plan, on another note I'll say, isn't a homeowner policy. Mm-hmm. It doesn't provide all the same coverage. It's limited coverage.
Yes.
And basically fire and wind and rain, and there's basic perils that it provides for, extended coverage. We, in addition to the Fair Plan policy, we have another policy called a difference in conditions, and a DIC.
Yep, that's what I'm familiar with.
Yes, and that supplements this Fair Plan. It kind of goes in and fills the gap so that now between the two of them, or with the two of them, I should say, you have a homeowner policy. The DIC includes liability, and it includes theft coverage, and there's a lot of little perils that it puts in. So the combination of the two makes a homeowner policy. So it isn't just the Fair Plan we use. We also work with the other companies to create a DIC.
Sure.
But they are the only game in town for certain circumstances.
And as an insurance company, I don't know if I'm just thinking too simple here. There's always got to be a number, right? If you're in the business of managing risk and insuring risk, and the risk is based upon a premium, right? The higher there's got to be a number, and that's where I guess it's weird to me for a company to just say, "Hey, we will completely not write this."
Well, that's where we are.
We are, and that's where the cost for the California Fair Plan is significantly higher. That's what I see.
Yes.
Plus, you have to have two policies. I mean, these are, again, more and more reasons to consult with an agent when you're looking at homes and you're looking to insure a property. But a
buyer should know going into the thing that what their costs are going to be, and if they're blindsided, oh, gee, I got to use Fair Plan, and a premium is something a lot more than what they would have anticipated as a tract home in the middle of Ventura, where you might get that for $1,000 or $1,200-$1,500, and then something in Tahoe or someplace is going to cost you $4,000 or $5,000, perhaps. They need to be aware of that going into it before they even complete the offer, I would think. And wrap that thing up. But there are these standard. The companies that we generally use. And you could say State Farm or Farmers or Safeco or Travelers or any of these companies you might think of. They're mostly what we call preferred companies, and then there is a layer of companies behind that, and they're called substandard or surplus lines companies we call, and they're higher premiums, but they accept higher risk. Then when we blow through those, and they won't even write the risk, that's when we step into this Fair Plan stuff.
Got it.
And so we go through these different layers, seeing who can we get to take this particular. We call them risks, those dwellings, and just see where we can accomplish the best job for the client. And in many cases today, the Fair Plan isn't that bad, really.
Yeah, I mean, I've definitely seen some $4,000+ and up. Plus the DIC policy on top of that, whereas, historically a property would have been insured for $1,800 with a policy. Now they're looking, $4,500 to $5,000. Right. So, it is possible, and you're right. And this is stuff, I guess, doing your diligence. How soon can you get a quote? Typically, when you place an offer on a home, I'd say that's a good time. When your offer is accepted, do it right away. You have a contingency period to do your diligence while you're under contract. So if you find out that California Fair Plan is your only option and it's a $10,000 policy, that could be a game changer not only on qualifying, but do you still want to purchase that property?
Exactly.
So doing your homework up front.
Exactly, and we see that often. Where people, kind of go shell-shocked is, whoa, holy mackerel.
Yeah.
what is going on here?
Exactly.
I didn't count for that.
Yeah, right. Maybe you can attest to this. I mean, is it fair to say that some of the insurance companies are getting a little bit more stringent on insuring and requirements?
Yes.
Okay.
Yes. Age of house, obviously location. How close the proximity to brush, and always along the ocean has been. There's that. The element that some carriers just say, oh no, none of that, and the brush obviously, but age, and there are these times when companies say we've got too much business in this area, that we're too saturated, and there can be that.
Yeah.
There are studies out there, believe it or not, behind the scenes where insurance companies buy into these, that they see the frequency of loss in a territory. We talked about frequency of loss on a single house earlier, but what about the area? And you might think of this like there's attractive houses that's built in the 50s, and now we're here in this time frame, and we're starting to see all these water losses, all these pipe failures, and insurance companies have access to that kind of data and can say, you know what, I don't think we want to write in that area anymore. It's just too much frequency of claim.
Cast iron's not good for water.
No. So there can be a lot of those kinds of factors, and so again, going to your point is that when a buyer is settled in on this wonderful piece of property they want, that they should start checking with their agent right away and say, here's this house, the address, is this going to be a problem? Or that's just a good easy question to ask. Is this going to be a problem?
Right. I actually just got a question from a friend of mine who owns many homes. He manages many properties. And he was saying that State Farm, his agent, just advised him that they're not going to be writing any more multifamily policies. So possibly maintaining the book of business that they have, but for the multifamily. Have you heard of that with State Farm or other carriers?
Well, I actually hadn't heard that about State Farm just yet, but I've seen this. I've been in this business a long time, and I've seen the companies come and go with their appetite. That's what we're going to call it, as an appetite. So we've seen it before. There was a time when State Farm didn't want to write any new homeowner policies, and that was, and then that obviously passed.
Right. Hopefully,
and now we're back. They're back. But yes, companies will lose their appetite for certain types of risks, and multifamily is right now it become a big problem. This isn't the topic of our discussion today. I don't think, is it?
Talk about it. Yeah,
okay.
Tell me what's going on with multifamily.
Well, we call apartment buildings. When we call, I'm going to say we make a distinction. 5 units or more is an apartment building. 4 units or less is still personal line. So, very
similar in lending. So we're residential 1 to 4, and then it's commercial 5+.
So those commercial things are really getting to be a pain right now because of the age. And many companies aren't going to write older properties. Anything over 30 years is starting to get a real problem unless we can document upgrades of plumbing, electrical, and roof, and all of that. And the same kind of holds true in the 1 to 4 units, multifamily things, that we are seeing carriers just. They don't want that unless they can. Again, it all stems to the age,
right.
and whether we can show that the property really qualifies for their program and their program. When I'm saying program, eligibility of their of writing, and it's moving. It's becoming more difficult, and all driven by claims.
Yeah,
and mostly in that area, it's water. It's water losses. We're seeing so much water loss.
Yeah. Well, not just pipes. I mean, it's the torrential rains. Right now, it's raining outside, right?
Right. So, and that leads to you got an old torn up roof, and it's letting water in, and that's doing a lot of damage, So there is that.
Hopefully, as a broker, this as a problem for State Farm could be a great opportunity for you. If you have some insurance lines or carriers that will insure multi-policies, then.
Well, there I go back to my beginning. I'm a broker. I'm an independent agent. I'm not we call it a direct writer or a State Farm agent. That only can go to that one company. Farmers, any of that. So there, I do have that advantage as being able to have multiple companies in my quiver to try to solve the problem with.
Yeah, very similar with American Pacific Mortgage. We're a direct lender, which I'd say for conversation that does tie us similar to like a State Farm or Farmers. We do everything in-house from underwriting to funding, although they do allow us to broker. If there's a product or a need or something that we do not have, then we're not going to leave our client high and dry. We want to make sure that we do take care of them. So, sometimes there is a time and place to broker, and sometimes it's the best option of, again, tightening up of risk here and there. Maybe there's some other option for your clients. So, no, that's good. Yeah.
Right.
Yeah. So what else insurance-wise can we share with some of the potential existing clients, new buyers? Multi-policy comes up sometimes. Maybe share a little bit about what multi-policy, and does that still provide discounts? Where are available discounts, Ben?
Well, multi-policy is certainly a discount out there, and that's typically where you'll write your insurance for your home and your auto with the same carrier. Say it's all with State Farm. So State Farm's going to give you a multi-policy discount. The companies we represent do the same thing.
Sure.
So I mean it's kind of a universal thing that way. But there with regard to a home, there are some things that again, carriers different. Some carriers will give you discounts for something where another carrier might not. Smoke alarms, burglar alarms, and that sort of thing. Some houses are fire sprinklers. You get a discount for that. That's be something as a new home buyer might make sure they mention to when they go through the house, look up on the roof or ceiling and see if there's fire sprinklers. And if there are, then make sure your agent that you're getting quotes from, agents that you're getting quote from, are aware of that so that they can apply that credit for you. Again, a burglar alarm can help. And I'm talking about a burglar alarm where it's wired to a central station, not that ring thing, necessarily, But anyway, but some have for the grease for around your stove for if it catches fire over there. There's certain alarms for that. There are some that you can put under your sink for drippage, and water, and that'll trigger. And there's some carriers give credits for that. So, they're again checking with your agent and find what credits that company he or she represents, what might be out there for you. But just talk to your agent, and let them know what you've got and all of that. And on that note, too, I would like to just say one more thing. Getting back into contents or personal property, the policies, like we mentioned, cover the things that are in your house, your television, your dishes, and clothing, all that. And there are other things that, like, say, for instance, jewelry and silver or money and things like that. They'll cover those types of things up to a certain amount. There's a limitation, and we call them sublimits. But so you need to know what those things are with the company you're dealing with. So we have some ladies out there that have some very, very expensive jewelry, and it's not necessarily going to be covered by their homeowner policy.
Right.
So they need to discuss this with their agent and say, hey, I've got this ring worth these thousands of dollars, and we might want an appraisal on it just to document that. But we can insure that to that full value, but just the basic homeowner policy isn't going to do that. So again, checking with your agents and making your concerns about the items you have, fine arts or whatever it might be.
All the watch collectors out there. There's plenty of watches that
that Rolex.
No, I mean many collectors now are into watches, and when they start collecting, it's not just one. There's 2, 3, 10. And some of these watches now are worth more than my home. So.
Well, there's antiques and things, and you can't really put a price on an antique, really. I mean, you get this table that was grandma's, and all of this, and you can't replace it. So how do you put a value on that? So there's things that you really kind of need to talk over with your agent and so on, and these special collections that people have, and what kind of value they have, and then in some cases that might want to be addressed with the agent as far as putting a special rider on that to cover those things.
Yeah. All right, I'm going to put you on the spot. You've been in insurance a long time. Any weird, quirky stories without names that come to mind? Something that you've insured that you're like, I don't know, something weird, anything?
Well, I had a very valuable poker chip collection stolen one time, and that I didn't know existed. On that, let me say one more thing.
Please.
When a person buys their home and they make improvements to their house, maybe they put on a deck, maybe they add a room, all this kind of stuff. You really need to tell your agent about this so that they can beef up your policy, beef in a good word.
Yeah.
Beef up, adjust your policy accordingly for that. That's added. We call it exposure. Added exposure for your insurance. So it's not our job as the agent to know what you've done.
Right.
You came in and put in granite countertops and cherry cabinets and all of that sort of stuff. And if you want that stuff insured, you really need to let us know. You added that bonus room or whatever. So I just want to make that.
No, that's good. I think every, I don't know whether it's every year, every other year, it's good to check in of, hey, what is new? I've owned my most recent home since 2019. It's been about 4 years, and looking back, I mean, I've done quite a bit from, cabinets in the garage to, closet cabinets and shades and awnings and new kitchen, whatever else my wife wanted. We did it.
Well, yeah, what the wife wants.
Yes.
And a lot of that, you might say, forget it, it's not that big a deal. And, maybe it is a big deal, but that's a judgment call that you make. So it's just, really good to make sure you keep up with your coverage with your agent. One more point on that is most policies, homeowner policies, include what we call an inflation guard. And it's an automatic increase of coverage to kind of keep pace with inflation. And that's usually a percent. And it could be 2%, 6%, 8%. It could be, the companies differ on what that percent might be. But that being said, each renewal, you'll see the limit of dwelling coverage go up.
I've noticed that.
Okay, and that's to keep pace with inflation. Well, we're having kind of record inflation now,
right?
And that
doesn't always keep up,
right? And in cases where it's the opposite, where there hasn't been much inflation, you might become overinsured. So again, these are things to review on at least every couple, 2-3 years with your agent, and be sure that the value, the dwelling limit on your policy is at least in the ballpark of what it's going to cost to replace the home, and using that and making sure your policy has that extended replacement cost to be that safety buffer.
Right. No, those are great tips. I got to hear more about this poker chip set, though. Come on. How valuable? Tell me how valuable this poker chip set is.
Well, this is going back, I'm going to say 20 years.
That's fine. I love it. I love
60 grand.
60 grand 20 years ago.
Yeah.
So in these poker chips,
I didn't see them.
You didn't see them? Mm-mm. Okay.
No,
I'm curious. Is it from like a casino and maybe they're no longer there? It was the original MGM in Vegas, and
it was all that.
Okay.
It was a person who played a lot of poker and made the rounds of these places you're mentioning, and had this collection. And I honestly didn't even know anything about it. And one day it was gone, stolen.
Yeah. Unfortunately,
we paid that claim.
Okay, this is the fun fact that I wanted to hear. Thank you. So, anybody listening with a poker chip collection, make sure and get that in, the proper coverage in your dwelling.
It'd be better to let us know up front about it, so that we don't have any questions. Because a big concern of mine, and it kind of ties into what we said. What we do, would you expect your insurance to do in any given loss? But is that there's not under expectations by the insurance company on the behalf of the client. I mean, I really wouldn't want my client to come in, well, I thought, and then they didn't have that coverage, or they didn't have enough of that coverage. Well, I thought, I've been asked by people, said, now I'm covered for everything, right?
Well, what is everything?
and my answer to that is no.
Yeah, right?
Every policy, besides being limited by the amount of dwelling coverage, the amount of contents coverage, and all those things we've previously talked about, every policy has exclusions.
Yes.
And I mentioned limitations on jewelry and stuff. So they have limitations, and they have conditions. There are things. There's elements of this policy. We call them sections to the policy, and so it's good to know what those exclusions are. In the case of a homeowner policy, two big exclusions I'll tell you about right now are flood an earthquake.
Right.
Those are separate policies that you buy.
Yeah.
And if you've got, we're always in an earthquake zone, but fortunately, by the grace of God, we've not had anything really devastating happen in our area. Flooding, that's a whole separate policy and a whole separate conditions, and so. Termite rot, mold and mildew, and policies are really designed. Homeowner policies are really designed to cover sudden and accidental type things that happen to us. We have a fire, we cover it, that kind of thing. But we have a water pipe that drips for 2.5 years, and then the black mold finally starts to develop and stuff. And you're going to have some problems with that claim. The gradual, continual. That's what we call a home maintenance thing.
Deferred maintenance.
That should have been taken care of. And so with exception here and exception there, those things may or may not be covered. Those gradual things. We don't pay for stuff that just rots, like the roof. If the roof just, it just rots. Now, if the wind blows it off and the water comes in, and we can deal with that. But just because your roof, it lasted longer than you thought it should. So you need to understand. Customers need to understand their coverage, and again, that's dealing or working with an agent that can explain this stuff to them and help them to understand. We don't like wood shake roofs anymore. That was.
I don't think any exist anymore.
Well, you'd be surprised. Ever so often you run into one.
Every so often, right? But, until the resell when they can't insure it.
Exactly.
And then it quickly goes away.
So, but understanding, what. Not only just the limits, but of coverage, for dwelling and so on, but what our exclusions are. What isn't covered. And no one wants to sit home at night and read their policy. I get that. But I know you do. But
no, I've read it once. You get these PDFs, or you log into your policy and it's 90 pages. I've gone through and looked at some of the exemptions, just curiosity more than truly. I didn't read all 90 pages, but. I perused through just to see what was excluded. But no, I'm glad you brought up, because this also plays into the housing, and we haven't spoken about it much other than you bringing it up for reference, is earthquake and flood insurance. So in the state of California, it's recommended that you do have earthquake, but we do not require you as a homeowner to have an earthquake, any earthquake insurance policy. Flood, we can, and that goes by a flood cert. So every home that we're going to lend on, we pull a flood certificate, and good old FEMA, which is the federal agency that oversees the flood maps and flood plains and the 500-year flood, whatever that is. They mark each property into different zones, and so the different zones would then trigger the requirement if you have to have flood insurance. In the Ventura area, I don't see that. Oxnard, I don't see that.
Santa Paula,
Camarillo.
You will see it in Santa Paula.
And I see it in Camarillo. I do Leisure Village, and it's right there at the hillside, and it kind of rolls down. And then, a lot of my Northern California clients, I can't really think of too many areas that are in a flood zone. So thankfully, there's an area of potential flooding, and a lot of times that just means, hey, if the local dam were to break, I think we'd all be underwater. But then there's this special flood zone, and that's the one that requires the flood insurance. And it ranges, I've seen policies as low as $500. I've seen policies as high as $5,000. It's a specific coverage for water, flood, damage.
There are factors like other things we've talked about here that enter into, obviously the location, how close it is to that river bank or the dry river, and the elevation. That's really the big trigger here is the elevation of it, and the foundation of the house, if it's on a slab or if it's on a raised foundation, and all of these are factors that enter into it. And like you're right, like you said, you can have a $500 policy or a $5,000 policy, right? But a lot of that is triggered, of course, on the dwelling limit. How much are we insured for $1 million or what? And then the other factors, the location and the elevation.
Yeah, absolutely. Well, insurance-wise, is there anything that we've kind of missed out for, consumers to really understand about insurance? Kind of went through some coverages, different types of insurance, recommend insurance, don't have multiple claims, please. Fires, California Fair Plan.
I think just to repeat that, get with an agent and talk about coverage and try to understand it to a moderate degree at least. So you just have a basic of understanding of what you're covered for, and if you have any special needs like the jewelry we talked about or other things, then deal with with your agent and you hammer that out and get an understanding that yes, I'm covered. Again, it's so bad if we have this conversation. I thought I was covered for that. Well, you weren't. You didn't tell me about that. Whatever.
I wasn't covered for everything.
It just ain't going to happen. So again, I'm not here to tell you to go with company A or company B or any of that stuff here. It's that I just encourage people to work with agents, not 800 numbers someplace and all of that. It's when you need your insurance, you need your insurance.
Yes.
And your agent can be there to help you. So I just encourage you to work with an agent and stick with, and price really. You hear all these commercials about, I'm going to save you $500 on this and that. Think about it. Can everyone save you $500 on something?
No.
And when it comes time for the insurance to be used, you want it to be there for you.
Right. And that's the last thing you want to do is, I learned, don't skimp on the insurance. You get in that 3-car pile up, or you've got that nice new home with all your toys and amenities, and something happens and you're underinsured.
I know we were talking mostly on home insurance and that, but you've mentioned several times about the car thing. Let me just mention one thing, please.
Yeah, no, please.
The state of California requires that we have insurance. True?
False. You can have a bond.
Yes. Okay, I stand corrected.
And let's clarify that. So I know that because some police departments do this. In lieu of insurance, they'll put up money. You can put up, I think, $30,000. I think it's a bit more than that. Whatever that number may be. But you have to front cash. So instead of saying, hey, I have insurance, you have cash that's sitting there in lieu of.
And I don't know about you, but I don't have that cash. So
well, I'm not going to tie up cash in lieu of insurance. Yeah, so sorry to interject.
But the state of California nearly always requires that we have insurance. And the insurance they're talking about is liability insurance. And of course, we have liability insurance, then we have comp and collision on your car. If you have a car that's new or financed, you're going to have comprehensive collision. I'm going to talk about the liability for a second. And this is where I encourage everyone to be cautious. The state of California requires that we have 15, 30, and 5. And what that means is the 15 and 30 part of it is what we call bodily injury, which means the damage you do to somebody else. Mm-hmm. So you're driving down the road, you hit somebody, and they get injured. That is bodily injury. The state of California requires you have $15,000 per person, okay, and then $30,000 per accident, and that's all they require on that. And then they also require that you have $5,000 of property damage, and that's the other guy's car. Okay, and we already talked about the Lexus. Okay.
Yeah.
Okay, so I want just to put that in perspective. Think about that. $15,000 for a bodily injury goes like how fast?
Well,
real fast.
Again, my personal story that I'm reflecting on that I've tried to forget. An ambulance did show up. There was a gal that smacked her head on the car, and
right.
There was a lawsuit out of this. Okay. It turns ugly fast, and you realize that $15,000 is not even a drop in the bucket.
Not at all.
Yeah.
And so that being said, I'm going to encourage people to consider getting some higher limits. And I'm not going to tell you what limits to have, but at least $250,000.
Yeah.
$500,000. In today's world, lawsuits happen so quickly, and they're encouraged by television people.
Call all fours for legal advice.
Yes. 1-800, call me. And So this is probably one of our biggest risks out there is what we do in our car. Especially today, you see people texting and not paying attention and doing their toenails or whatever they're doing in the car, and things happen, and it can get ugly really quickly. And part B of what I wanted to say about this is that $5,000 part. That's the property damage that's required by limit of coverage that is required by the state. There ain't a car out there that's worth only $5,000,
Right.
And look at Teslas and I've seen Teslas so much nowadays,
Right.
And they're
the new Prius. That's the way I see it.
They say they start at 35, but it's really 50.
Yeah, right.
and then any car you look at out there is just the prices are so crazy nowadays. So I would say look at your coverage with your agent, look at your coverage limits, and try to be realistic. Especially now you're going to be a homeowner, and that's an asset. Which guess what? They can come after that.
Right.
So.
Right.
And last thing, just because you don't have enough insurance to cover the claim doesn't mean you're off the hook.
Right. No, understandably.
Because their lawyers can still say, you know what? What are your assets? Bring them in here. Let's lay them on the table and see where else we can get a dime. So talk with your agent, get that settled.
And a lien, let's say before you own a home, you get into a lawsuit, you have a lien, that could impact you even purchasing a home, which, that's a big deal. It ultimately turns into one of your largest assets and one of the greatest achievements that we have. And to have that stricken from us just because of an accident or being underinsured. The other thing that I learned about, and again, everything was the hard way, was you have your auto policy and then you have your home policy, and then there's oftentimes a recommendation of an umbrella. Right. So if something you hit, not only a Lexus, but look at how many sports cars are on the road. Cool. You hit one of these Ferraris or Lamborghinis or McLaren. I mean, Mercedes nowadays. I mean, you can name a lot of these cars that are several hundreds of thousands, if not a Bugatti that's multi-million dollars. You could go bankrupt. I mean, just in a blink of an eye, you thought you were covered for $300,000, and they're coming after your home as well. And so the umbrella, kind of maybe share a little bit more about the umbrella.
Well, umbrella is a policy, or oftentimes called an excess liability policy. And it provides an extra amount of liability insurance on top of your, what we call them, primary or your underlying policies. So the underlying policies are these. Your homeowner policy has some liability coverage in it. We talked about that.
Yes.
Your automobile policy has some liability in it. So those are the underlying policies. And if you had a motorcycle and a boat and a motorhome, all of those would be underlying policies. If a claim were to occur and you exhaust those limits, let's say your automobile had a $500,000 limit in it, and you blew through that with this claim because it was a $750,000 claim.
Yeah.
The umbrella would come in and take care of that amount over the $500,000 up to the limit of the umbrella. Umbrellas typically start at $1 million, so of coverage, not premium coverage. So in a case of a $500,000 auto policy and $1 million umbrella policy, you'd have $1.5 million of coverage to deal with that particular loss on.
Yeah. My experience, they're not that much.
No.
They do require you to have ample coverage. You can't just come in with the cheap policy and say, hey, let's throw an umbrella out it.
Right.
They want to have you properly insured, and then they say, okay, you're properly insured. Let's just sweeten the deal here. Let's offer the umbrella, and for less than $1,000, less than $500, depending upon what that number is, you can really protect yourself.
In many cases, you can get an umbrella policy, $1 million umbrella policy for $300, $400.
Yeah,
a year. So
I think I forced this out of you, but I think the conversation today is get more insurance, everybody. I'm over here like second guessing myself. I know I'm covered well, right? Right?
Well, it's something that should be reviewed. And again, an agent. Did I say agent?
You said agent.
Okay, good.
Yes.
Agent out there.
Yeah.
So.
Well, again, I've shared with the mortgages, it's very similar. We need to be that eyes and ears, the voice to guide you in your goals. And, a lot of consumers can read all they want online. They can go to the interweb and find lots of stuff, but you also get lost in that, or you don't find in that one case. That's where the knowledge, the experience of a professional, insurance professional, mortgage professional, we're here to help you. We're here to guide you. And there's a lot of one-on-one scenarios, right? It's not just as easy as the cast iron pipe that busted. It's, my neighbor's cat hit my car in reverse and backed into my house. Who's at fault here?
Right.
So that's where, again, I like that you're emphasizing, just as I am, that get the agent involved. And, we're going to kind of wind it down here. I'm going to just kind of share. I've known Ben for about 12 years. I've met him at the university club. And through that, we've developed a relationship as friends, but also as business relationship. Right. And one of the things that stands out of why time and time again I refer him, it's not just getting a quote. And I think there's a lot of companies that are eager to get your business up front. It's, hey, let me get you a quote. His team, himself, they'll get you a quote right away. They're very fast as they can be. Now, if it's a, more in-depth California Fair Plan, you got, hey, I've given them properties that have brush right up the backside of it that I'm upfront with of, hey, I know this one's going to be tough.
Right.
Don't just throw us the cheapest, but, price, quality, give us the insurance that we want. Him and his team are always there to get us those quotes. The other thing I'm going to say is, again, it's not just the quotes. Anybody at the quoting process should be phenomenal, right? Because that's potentially a new business, new client.
Right.
But when it's time for the refinance and you have an insurance company, or a lender that's calling to make changes to your policy, the customer service that I get from your company is hands down the best. And that's really where I can say you guys shine. I know Veronica, she's one of your great members that helps with your insurance. When I send her a request, it's just handled. And not only that, it's handled without errors. So many times, I mean, we all make errors, but time is money, and that's where it's something that really it makes it challenging if we both have to go back and forth correcting a typo on a loan number or the borrower's name.
Right.
Then it just wastes time. So in terms of knowledge, availability, I've always called your office. You're always answering the phone for me. You guys, hands down, I couldn't appreciate you more. And so it was a no-brainer to have you on today.
Thank you.
I'm thankful for you coming and sharing your knowledge and wisdom.
Enjoyed it so much.
And I know who I'm going to call to insure my poker chips.
Thank you so much for having me today.
Last thing, Ben, where can they find you? How do they get a hold of Suddock Insurance Agency?
We're located in Ventura, and 805-644-0245. Call us and we'll chat.
Sounds great. Thanks again, Ben.
Thank you.
All right, this is G Money. Have a good one. Peace.
That was fun. Thank you so much.
An hour and 12 minutes. We did it. And my phone was just now. I hope I didn't lose any video because it was going on low.
Uh-oh.
But we got all the sound. We did good.
Good.
How was that?
I enjoyed it. I thought it was great. I think we hit a lot of topics, and it's informative, and there isn't anything I wouldn't change.